Silver has just experienced one of the most violent declines in modern trading history, 10% in hours. But here's what the headlines are not telling anyone. When silver crashes this hard, this fast, it is not about silver. Gold fell simultaneously, bonds are trembling, and the smart money, the institutional money, is liquidating everything they can touch. This is not a correction. This is a margin call. And when the most liquid assets on earth are being dumped at any price, the question is not why silver fell. The question is, what comes next? Welcome to Boring Currency, the one place where financial events are explained, not dramatized. If this analysis has value for your understanding of what is unfolding in real time, consider subscribing. Think of it as keeping a reliable financial newspaper on your desk, the kind serious businessmen used to read every morning with their coffee. We are curious, where are you watching this from today? Which part of the world are you observing this crisis from? Drop your location in the comments. Now let us dissect exactly what happened and what it means. On this particular trading day, something extraordinary happened in the precious metals market. Silver fell 10%, not over a week, not over a month, but in a single trading session. The price opened at $80.83 per ounce, and by the closing bell, it had collapsed to $72.75. That is a loss of $8.08 in mere hours. For context, silver typically moves 1 or 2% in a day. 3% would be considered volatile, but 10% is not normal market behavior. When experienced traders saw their screens, they recognized something immediately. This was not ordinary selling. This was panic liquidation. The trading volume told the story. It was 3 times the normal daily average. Orders were hitting the market with unusual size and unusual speed. But silver was not alone. Gold, the most stable monetary metal in human history, fell 3.6% in the same session. Platinum dropped 4.2%. Mining stocks, the companies that extract these metals from the earth, were down even harder, some declining 12 to 15%. When an analyst sees all precious metals falling simultaneously with this velocity, with this volume, they know they are witnessing something specific. They are witnessing a liquidity event. So what exactly is a liquidity event? In simple terms, it means someone, somewhere, desperately needs cash. Now, not tomorrow, not next week, right now. And when institutions need cash immediately, they do not sell what they want to sell. They sell what they can sell. They sell the assets that have buyers ready, assets that can be converted to cash within minutes. Silver and gold are among the most liquid assets in the world. There's always a buyer, always a market, always a price. So when a fund or bank faces a margin call, when their broker demands immediate payment, precious metals are often the first things they liquidate. But here is where it gets interesting. The fundamentals of silver had not changed. The supply had not suddenly increased. The industrial demand had not collapsed. The monetary situation had not improved. Nothing about silver itself had changed. Yet the price fell 10%. This tells experienced observers something crucial. The price movement was not about silver. It was about the seller. Someone was forced to sell. And when forced selling enters the market, prices disconnect from fundamentals. They disconnect because the seller is not negotiating. They are not waiting for a better price. They are simply accepting whatever bid is available. This is the signature of distress. Now the critical question becomes, who was selling and why? The answer requires understanding how modern financial institutions operate. Large funds do not simply buy and hold assets. They use leverage. They borrow money to amplify their positions. A fund might have 100 million, but through borrowing they control positions worth 300 million or even 500 million. This works beautifully when prices move in their favor. Profits are multiplied. But when prices move against them, losses are also multiplied. And here is the mechanism that creates crashes. When a leveraged fund loses money on one position, their broker calculates their total risk. If that risk exceeds certain limits, the broker issues a margin call. A margin call is simple. It means deposit more cash immediately or we will liquidate your positions. The fund then has a choice. Scramble to find cash or start selling assets. And which assets do they sell first? Not the illiquid ones, not the real estate or the private equity or the complex derivatives. They sell the liquid ones, the ones with ready markets, the ones that can be converted to cash before the deadline. Silver, gold, government bonds, large cap stocks. And once the selling begins, it creates a cascade. The selling pushes prices lower, which triggers margin calls at other funds, which forces more selling, which pushes prices even lower. This is not a market correction based on new information. This is a mechanical process, a forced unwinding of leverage. And the violence of today's decline in precious metals suggests the unwinding is not small. It suggests somewhere in the financial system, someone very large is in very serious trouble. The question now is whether this is an isolated event or the beginning of something broader. To understand what is truly happening beneath the surface of this crash, one must imagine a specific scenario. Picture a large institutional fund. Let us call them Titan Capital. Titan Capital manages $14 billion, but they do not simply hold $14 billion in assets. They control $38 billion through leverage. They borrowed $24 billion to amplify their returns. Their portfolio is diversified: equities in technology and healthcare, corporate bonds, government treasuries, and a substantial position in precious metals. On paper, everything looks balanced, risk managed, professionally structured. Then something shifts. Perhaps it is a surprise interest rate decision. Perhaps a geopolitical event. Perhaps a single trade that moves violently against them. In this case, let us say their currency hedge on the Japanese yen suddenly reverses. They were betting the yen would weaken. Instead, it strengthened sharply. In 2 trading sessions, they lose $900 million on that single position. Now, their broker, the entity that lent them the $24 billion, runs the numbers. The broker calculates what is called the portfolio's risk-weighted exposure, and the computer system flags a problem. Titan Capital's equity cushion has fallen below the minimum threshold. At 4:47 p.m. Eastern Time, the phone rings at Titan Capital's risk management desk. The voice on the other end is calm but firm. You need to post $2 billion in additional collateral by tomorrow morning, or we begin liquidating positions. $2 billion by morning. The crisis begins. Titan Capital does not have $2 billion in cash sitting idle. No sophisticated fund does. Idle cash is inefficient. Their CFO immediately starts making calls. Can they borrow from another institution? Can they negotiate an extension? Can they find a counterparty willing to take over some positions? But here's the problem. It is not just Titan Capital. 3 other major funds received similar margin calls the same afternoon. Why? Because the same currency move that hurt Titan Capital hurt them too. They were all positioned the same way, following the same models, chasing the same returns. This is the hidden danger of modern finance. Concentrated positioning. When everyone believes the same trade is safe, when everyone uses similar risk models, when everyone borrows to amplify similar strategies, they all face the same crisis simultaneously. So when Titan Capital calls around looking for emergency liquidity, they find other institutions are also scrambling. Nobody wants to lend. Everyone wants to preserve their own cash. By 7 p.m., Titan Capital's leadership makes the decision. They will liquidate. But what do they sell first? Their private equity stakes? Illiquid takes weeks to find buyers. Their real estate holdings? Impossible to sell overnight. Their complex derivative positions? These require unwinding carefully or losses multiply. No, they sell what the market will absorb immediately: gold, silver, liquid government bonds, blue chip stocks. At 9:31 a.m. the next morning, when markets open, Titan Capital's trading desk begins executing. They are not looking for optimal prices. They are looking for immediate execution. Sell orders flood into the silver market. 400 contracts, 800 contracts, 1,200 contracts. Each contract represents 5,000 ounces. The market absorbs the first wave. Prices dip slightly. Then the second wave hits. Prices fall harder. By 10:15 a.m., silver has dropped 4%. But now the cascade mechanism activates. Other funds hold silver, and as the price falls, their portfolios show losses. Some of these funds are also leveraged, and the falling silver price pushes them closer to their own margin limits. At 11:03 a.m., a second fund receives a margin call. They too begin liquidating silver. The price falls another 3%. By noon, algorithmic trading systems detect the volatility. These computer programs are designed to reduce risk automatically when volatility spikes. They sell not because a human decided silver was overvalued, but because the algorithm detected price movement exceeding historical parameters. Now 3 forces are selling simultaneously: forced liquidation from margin calls, precautionary selling from risk-averse funds, and algorithmic selling from computerized systems. The price drops to $74, then $73, then $72.75, 10% down. But here's what makes this truly dangerous. Titan Capital did not start this crisis because they hated silver. They actually believed in silver as an inflation hedge. They are selling because they have no choice. And when institutions are forced to sell assets they fundamentally believe in, when they are dumping positions they want to keep purely to meet cash demands. That is when observers know the financial system is under serious stress. The margin call cascade does not stop at precious metals. Titan Capital also sells their bond positions, their equity positions, anything liquid, and each sale pushes those markets lower too. This is how a crisis in one corner of the financial system spreads. Not through contagion of bad assets, but through the mechanical necessity of raising cash. The critical question becomes, how many other funds are in Titan Capital's position? How much more forced selling is coming? And will the cascade stabilize or accelerate? What happened today in the silver market is not new. History has seen this pattern before, and those who study financial history recognize the fingerprints immediately. September 2008, the global financial system was collapsing. Lehman Brothers had just filed for bankruptcy, the largest bankruptcy in American history. Credit markets were frozen. Banks refused to lend to each other. Trust had evaporated. And in the middle of this chaos, something strange happened. Gold fell, not slightly, not gradually, but violently. On September 16th, 2008, gold dropped from $850 to $772 in a single session, 9% in one day. Silver fell even harder, nearly 12%. This confused many observers at the time. The logic seemed backwards. If the financial system was collapsing, if banks were failing, if paper currencies were at risk, should not gold and silver, the ultimate safe havens, be rising? But they fell. And the reason reveals everything about how liquidity crises actually function. Hedge funds in 2008 were massively leveraged, some 30 to 1, some even 50 to 1. When Lehman collapsed, these funds faced catastrophic margin calls. Their equity portfolios were collapsing. Their mortgage-backed securities were worthless. They needed billions in cash immediately, so they sold the only things that still had functioning markets: treasury bonds and precious metals. Gold and silver fell not because they were bad assets, but because they were the only good assets left that could be converted to cash. The institution selling gold desperately wanted to keep it, but survival required liquidity. And here is what happened next. By October 2008, the Federal Reserve intervened. They announced unlimited dollar swap lines with foreign central banks. They dropped interest rates to zero. They began quantitative easing. Liquidity flooded back into the system. And once the immediate crisis passed, once institutions were no longer facing extinction, they began buying back the assets they had been forced to sell. Gold bottomed at $712 in October 2008. By December, it was back above $850. By 2011, it reached $1,900. The forced liquidation created the buying opportunity, but the recovery required massive central bank intervention. Now move forward to March 2020. A different crisis, a pandemic, but the same mechanical response. On March 9th, 2020, global markets opened to chaos. Oil had collapsed. The S&P 500 fell 7% in a single day, and once again, gold and silver fell. Gold dropped from $1,780 to $1,450 in 2 weeks. Silver crashed from $18 to $12, a 33% decline. Why? Because March 2020 saw the fastest margin call cascade in modern history. Everything liquid was being sold to raise dollars. Institutional treasurers were not asking what's gold worth. They were asking, what can we sell immediately? The answer was gold, silver, government bonds. The Federal Reserve watched this for exactly 8 days. Then on March 15th, they announced emergency measures. Interest rates cut to zero, $700 billion in quantitative easing, unlimited repo facilities. They opened the liquidity floodgates. And again, once the cash crisis subsided, precious metals reversed. Silver bottomed at $12 in March 2020. By August 2021, it reached $30. The pattern repeated. Forced liquidation, central bank intervention, recovery. So what does history tell us about today's crash? First, when precious metals fall this violently, it signals institutional distress. Someone large is in trouble. Second, the crash typically precedes broader market stress. The precious metals move first because they are most liquid. Third, recovery depends entirely on central bank response. Without the Federal Reserve's intervention in 2008 and 2020, the crashes would have continued. But central banks stopped the panic by flooding the system with liquidity. However, and this is critical, today's situation has one major difference. In 2008 and 2020, inflation was not a concern. Central banks could print freely. But today, inflation remains elevated. The tools that worked before may not be available. If the Federal Reserve responds to this liquidity crisis by printing money again, inflation could accelerate beyond control. If they do not respond, the liquidation